Hi there, and welcome back to the Business Career College video series. We're going to look at the Registered Retirement Savings Plan in some detail in this series of videos. There is a lot to know about RRSPs, and we're going to try and cover off a fair bit of the detail here. So we'll be looking at the Registered Retirement Savings Plan, or the RRSP. Now, before we get into any kind of detail about the RRSP, the first thing that I like to do always is to dispel a couple of misconceptions that I quite often run into around the RRSP. And the first is just around some of the terminology, and you'll hear this all the time. We'll hear this at tax time often where somebody says, I went to the bank today and I bought an RRSP. There's no such thing. You don't buy an RRSP. What you're actually doing here is you're using some sort of investment within your RRSP. So what you'll do is you'll go buy something like a stock, a bond, a mutual fund, a segregated fund, something like that. And the financial institution that sells you that investment will register it for you, and then it becomes part of your RRSP. All that means is that you have some particular tax advantages associated with that investment now that you wouldn't have if you invested on a non-registered basis, and some tax restrictions as well, which we'll talk about as we go through this section. The other misconception, which is less frequent today, is around risk. Occasionally, I'll run into the misconception that you can't lose money in your RRSP. I think most people were disabused of this misconception in the wake of the 2008 credit crisis, where we did see a lot of losses within both registered and non-registered accounts. Okay, so where are we going to start then? Let's look at who can contribute to the RRSP. So we're going to look at contributions into the RRSP. In order to make a contribution to the RRSP, you have to have earned income and be a Canadian resident. And what we do here is we take your earned income times 18%. Okay, that 18% is so frequently an exam question on all kinds of financial services exams, you absolutely must know that. Now there is a maximum. The maximum varies year over year. So for example, for 2013, that maximum is $23,820. You'll generally be given that figure if you need it for exam purposes. And for 2014, that maximum is $24,720. That figure is indexed, so it's actually legislated that that figure grows with inflation, and that's why we see these changes year over year. When you make a contribution into an RRSP, then what happens is you have a tax deduction, which is the first of our tax advantages associated with the RRSP, and I would suggest that's the one that most people are most aware of. That tax deduction means that basically you're not paying tax on the income that you are contributing to your RRSP, at least not yet. Now, the other thing to note about the RRSP is that there is no minimum or maximum age at which you can contribute to an RRSP. Many financial institutions will not allow somebody under the age of 18 to hold an RRSP, and that's fine, but the Income Tax Act doesn't prohibit contributions. And many of you are probably saying, well, hang on a second, I know I can't have an RRSP past the age of 71. That's absolutely true, and we'll deal with that in more detail in a few minutes. So how can I possibly contribute to an RRSP after 71? Well, I can't contribute to my own, but there are two people whose RRSP I could contribute to. I can contribute to my own RRSP, or I can contribute to a spouse's RRSP. So the ability to contribute to a spouse's RRSP means that if I'm beyond the age of 71, but I happen to have a younger spouse, then I can still make RRSP contributions on a spousal basis. Okay, so when you contribute to the RRSP, the other tax advantage that you'll have here is that the growth, hopefully, growth is not guaranteed here, you certainly can suffer losses, will be tax deferred. Unlike other investments, normally, for example, if I hold a mutual fund or a stock or a bond or a segregated fund, and it generates some sort of returns for me year over year, I will have to pay tax on those returns. In this case, though, I don't. My returns here will be tax deferred. Now, just while we're on the subject of the investments that can be held in the RRSP, a frequent set of exam questions rotates around what you cannot hold in your RRSP. And one of the big ones that you cannot hold in your RRSP is real estate. There used to be more restrictions around precious metals, but today there are some precious metals choices you can have in your RRSP. And there are some derivatives contracts you can also hold in your RRSP, but real estate is still a big one. And then another thing that you can't hold in your RRSP, at least not directly, are your collectibles, things like your collection of fine art or whatever you have. And there are ways to hold real estate and even collectibles, but those are going to be through funds where you don't have a direct investment, but rather you have an indirect holding of those investments. So what's going to happen now with your RRSP is you're going to have this growth, but you will have to mature your RRSP at some point by December 31st of your 71st year. Okay, that's not to say that you have to wait that long. In fact, you could mature your RRSP anytime you want, but you have to do it by that time. So you could do this at 25, although it would be an unusual decision. You could do this at 50. You could do this at 60. You could wait right up until the last possible minute and do this on December 31st of your 71st year. That is the year in which you turn 71. Now, when you mature your RRSP, you will have three choices as to what you do with that. And the choice that I think most people consider today is the Registered Retirement Income Fund. The RIF. And basically, the RIF is very much like the RRSP with a couple of notable exceptions. That is, you can make no more contributions, but you're still going to have investments. In fact, still choosing from the same range of investments as you chose from with your RRSP. Most people, when they move from the RRSP to the RIF, just keep the same investments they previously had. They may do some rebalancing, which we'll discuss elsewhere. They may do some rebalancing, but really, all they're going to do is just roll whatever investments were held in the RRSP right into the RIF. And then the other characteristic of the RIF is that you have a forced annual withdrawal. You actually have to take some money out of the RIF each and every year. Okay, so that's one of your choices. Other choices that are available are an annuity. This would be a registered annuity. And a classic decision here is whether or not I'm going to use a RIF or an annuity. And generally, with the RIF, I'm still invested, and I have the risk associated with investment which also means I have the opportunity for greater returns. With the annuity, I'm going to have a fixed income. I know exactly what my income will be, but I take out the risk, and therefore I take out any opportunity for better returns. So no additional returns here. So if I'm looking for fixed income for the rest of my life, I'm going to choose the annuity. If I want to still be able to benefit from market fluctuations, I'm going to choose the RRSP, or to choose from a wider range of investments, I'm going to choose the RRSP. There is a third option. It's to take it as cash, which might sound unusual. The problem with taking cash is that you would end up with all of your RRSP taxable then in your hands. But if you have somebody who has a relatively small RRSP, they could they could just mature the RRSP and take the cash. Whatever you do, the dollars that end up in your pocket, the dollars that you can actually spend, are taxable. And they're taxable as ordinary income. There's no particular tax advantage to those dollars. They're going to be taxed just like any other kind of income. Okay, so then you do have the opportunity to make withdrawals from your RRSP anytime you want. In fact, you can make a withdrawal anytime you want. However, those withdrawals are going to be subject to a withholding tax. We'll talk about that withholding tax in another video, unless you withdraw those amounts for one of two very specific reasons, and those are the home buyer's plan, which we'll also talk about in another video, and the lifelong learning plan. So that's the broad overview of the RRSP. There's a lot more detail to go into, but that gets us started. While I have this picture up on the screen, I want to point one more thing out, simply because there's a lot of confusion that I run into, especially with newer students around the RRSP, and that is we're going to have this whole alphabet range of plans. In fact, when we look at these investment options over here, you'll see the same investment options with You have the same options or the same choices when you're using a RRSP, when you're using a LIRA, when you're using a LIF, and then a whole bunch of other tax advantage plans give you very similar choices. It gets to be a little bit of an alphabet soup, and it can be confusing. So what I like to show students is that if you keep your R's together, I know it's corny, but if you think like a pirate here, keep all your R's together, okay, that will help you to recognize what plan fits where. So the RRSP and the RRIF, these guys fit together perfectly. You'll go from RRSP to RRIF. You don't go from an RRSP to a LIF, and you don't go from a LIRA to a RRIF. Okay, you go from RRSP to RRIF. You have other choices, of course. You also have cash and annuity, but you stick your registered plans together, the R's all fit together. I hope that's helpful. I hope you learned something about the RRSP and you're able to proceed through the remainder of the video series covering the various registered plans. Thank you very much. Hi, and welcome back to the Business Career College video series. This is Jason Watt from Business Career College, and what we're going to talk about today, we're going to enhance our understanding of RRSPs a little bit by looking at some RRSP math. I know everybody always gets all excited about the concept of doing some math, but we do have to go through some here in order to understand a little bit better how the RRSP works to see some of its characteristics and how they benefit us. So the first thing we're going to do is we're going to look at somebody's income. So let's say that we have income, in this case, for the 2013 year. And my taxpayer in this case has the following sources of income. We'll give them salary of, let's say, $88,000. We'll say they earn a bonus of, how about $8,000? They have some dividend income of $3,000. That is income earned as a result of owning shares and being paid a chunk of the after-tax profit from those shares. They have rental income of, how about $14,000? And they have rental losses or rental expenses of $8,000. And as it happens, this person is paying spousal support to another person. So we'll have paid alimony or spousal support. We'll say they're paying $12,000 of that. So what happens first here is we have to determine what we're trying to actually answer. So a common exam question here would be, what is the 2014 RRSP deduction limit? Very common type of exam question. And it is important that you look at the years here. The 2013 year's income is going to determine the 2014 deduction limit. Okay, so that's the question you're dealing with. You know you're dealing with 2013's income to determine 2014's deduction limit. Okay, so now we have to determine what income we're actually going to include here. So the salary, are we going to include salary? Yes, that is an example of earned income, and we would include that. The bonus is another example of earned income and would be included. The dividend, though, is not considered earned income for this purpose and would not be included. And then with the rental amounts, we include the net amount. So 14,000 less 8,000, we would include here 6,000. And the alimony paid, curiously, reduces your RRSP deduction limit. So in the end, for this taxpayer, we would take 88,000 plus 8,000 plus 6,000 minus 12,000. That will give us $90,000 on which to base our RRSP calculation. You'll remember, of course, that we're going to use 18% of the earned income, so $90,000 times 18% gives us $16,200. In and of itself, that will be the answer to this question if there's no further information provided. However, that would be an unusual situation. This would be a fairly simple question in and of itself. The only thing that students would sometimes get caught up on here is which amounts, especially out of these bottom four, which amounts contribute to and which amounts reduce the RRSP deduction room. That is something you generally have to be aware of. Now, you might have another scenario at play here, or another bit of information available. We might also be told that this person is a member of a defined benefit pension. At some levels, at the CFP and mutual funds exam levels, for example, you do have to know the formula for a DB pension. At the LLQP level, you don't need to know it. You just need to recognize what happens when you have what's called a pension adjustment. And the pension adjustment in this case, let's say, just for the sake of argument, that it's $10,400. So what happens then is that pension adjustment represents the combination of this taxpayer and their employer's contribution to defined benefit plans for this year. And because the defined benefit plan uses a very similar set of rules to the RRSP, almost identical in fact, we're going to use both of those items together to figure out the RRSP room. So in fact, that $10,400 pension adjustment knocks down this person's RRSP room, and this person will now have $5,800. And if we have this information available, this is now the right answer. $5,800 is the right answer to this question. Okay, now, there are a couple more things that we have to be aware of here. The first is that we can carry this forward. And under current RRSP rules, we can carry this forward indefinitely. So if you don't use your RRSP room this year, you can carry it forward. Or the other thing that you might consider here is the ability to over-contribute to the RRSP. Normally, when you go beyond your RRSP deduction limit, you have a 1% penalty per month on the amount over. However, we do have the lifetime over-contribution allowance. And what the lifetime over-contribution allowance allows for us to do for RRSP contributors over the age of 18 is to put an extra $2,000 into their RRSP. That's not tax deductible. However, it doesn't create any penalties either. Now, you can't do that every year. You can only do that really once, and then that lifetime over contribution allowance is gone. There are some finer rules around that, but basically it comes down to one permitted over contribution of up to $2,000, or a sum total of RRSP contributions of up to $2,000. Okay, that's all relatively straightforward now. It's a lot of rules, a lot of detail, but nothing terribly complicated. I do want to introduce one more scenario here. My taxpayer, as it happens, has a spouse, and the spouse for the 2013 tax year has income of $8,000. They just work part-time. Maybe they tend bar at a local pub on weekends or something like that. And they have $8,000 of income as a result. So this person has, times 18% again, $1,440 of RRSP deduction room available for that year. However, we want to look at really, is it practical for this person to contribute to an RRSP? The benefits of contributing to an RRSP, of course, are tax deductions and tax deferred income. Well, if you're only making $8,000 a year, you're not paying any tax. That puts you below the basic personal amount. You're not paying any tax at that level of income. So a tax deduction doesn't help, because if you're not paying any tax, we can't deduct anything from your tax payable. And tax deferred income doesn't help, because at that level of income, you're really not paying any tax. So you might as well just earn taxable income and pay tax on it. The problem then is, if this person doesn't invest, if they make no investments, we're going to end up in retirement with the spouse ultimately with no retirement income. Well, we have everything with the taxpayer over here. The taxpayer will have all the retirement income. And if you remember how the tax brackets work, you'll see that's not terribly efficient. We're generally better off to have two moderate levels of income than we are to have one very high and one very low level of income. So the way we're going to, or one of the methods we're going to use to accomplish this, and we will talk about income splitting in more detail elsewhere, but one of the methods we're going to use to accomplish this potentially is maybe have our taxpayer contribute to a spousal RRSP. And by using the spousal RRSP now, we're going to put some income into this person's hands. So now they will have retirement income, and our original taxpayer will not have all the retirement income. Instead, we'll have a nice mix. So what happens then is the contributor, they're going to use their RRSP room and lose it as a result. And they're going to get the deduction. And then the recipient actually owns the RRSP in what's called a spousal RRSP. They would make the investment decisions. They would decide on any kind of withdrawals. It's their RRSP. Okay, so a lot of concepts covered in this video. We saw the basics of RRSP math. We saw the pension adjustment. We saw the actual calculation of RRSP room, including lifetime over contribution allowance, and we introduced the spousal RRSP. That's a lot of stuff. I hope that it does help you to better understand the RRSP. Please do let me know if you have any questions. Thank you very much. Hi, and welcome back to the Business Career College video series. Today we're going to talk about the spousal RRSP. Now, in other videos, we've talked about how funds get into the spousal RRSP. In this video in particular, I'm concerned about how funds get out of the spousal RRSP. So let's say we have a couple here. We have, let's say, Vicky. And Vicky is a high income earner. She does well. And she earns, let's say, $150,000 a year, and makes full use of the RRSP as a result. As it happens, she is married to Sam. Okay, Sam has no income. He makes no income at all every year. He's really good at Xbox though. And Sam has no income here. So Vicky says, well, that's the perfect situation to use an income split. And the particular income split we're going to use here is the RRSP. So what happens is Vicky does contribute her own RRSP, but she also contributes $5,000 per year to Sam's RRSP. Okay, so the result, of course, is that Vicky gets the tax deduction for that. Vicky uses her RRSP room, but the downside then is, of course, Sam has complete control over the RRSP, which might not be a downside if Sam is in fact responsible and can handle that well. So let's say we go through a number of years here. In 2012, Vicky does this. She puts $5,000 in to Sam's RRSP. And in 2013, she does the same thing, another $5,000 in to Sam's RRSP. And the RRSP year for the purpose of calculating spousal RRSP contributions is the same as the normal RRSP year. That is, it goes 60 days into the next calendar year. So you actually have until usually March 1st to make contributions to a spousal RRSP, just like to your own RRSP. So now in 2014, we're going to work through a scenario. Let's say that in 2014, early in the year, before Vicky's had the chance to make any RRSP contributions into Sam's RRSP, he has this great idea. He says, I want to take some funds out of, he wants to withdraw some funds. He wants to withdraw $12,000 from his RRSP, and it is his RRSP, the spousal RRSP, because he has some new gadget he wants to buy or whatever the case is. He has no income of his own, so this is his big chance. So what happens around this is that, in fact, we're going to undo, we're going to go back to the current year plus the previous 2 years. And we're going to undo basically any tax advantage that Vicky had in that period. So we go back to 2013, we go back to 2012. Vicky had tax deductions in those years. We're going to undo those tax deductions. Basically, that means Vicky is taxed on, in this case, $10,000 of income based on Sam's RRSP withdrawal. The remaining $2,000, amounts that were deemed to have gone in prior to 2012, well, that's Sam's own. So Sam would have income of $2,000 in this case. So out of that $12,000 RRSP withdrawal, we know it's going to all be taxed as income. However, $10,000 of it is attributed to Vicky and $2,000 of it is attributed to Sam. Probably doesn't make Vicky terribly happy. It's not a very tax efficient way to do things, but this stuff does happen. Now, let's say that on Sam's way out the door, Vicky asks him what he's doing. He's caught here. He says, no, I wasn't going to go take money out, or whatever the case is, and we don't end up having this happen. Okay, so Vicky says, well, I know what you were going to do, so I'm not going to put any more money in. So instead, in 2014, we have nothing in and nothing out. And then in 2015, once again, we have nothing in and nothing out. And then in 2016, this is the year when, if we have nothing go in, this is where Sam could take out it all out, and it would, all tax consequences would be Sam's now. But we have to go 2 full years without any withdrawals, any contributions, and only then do we start to have Sam with the ability to take that money out. There is one more way that we could work around this. I'll talk about that when we talk about the RIF in a separate video. But just within the context of the RRSP, this is exactly how it would work. I hope this helps to understand the income splitting provisions around the RRSP and some of the limitations we have with the spousal RRSP. Thank you very much. If you do have any questions, please let me know. Hi, and welcome back to the LLQP video series. This is once again Jason Watt, and we're going to talk today about RRSP withdrawals. Now, when we take funds out of an RRSP, that is taxable income. So income from an RRSP is taxable. And that's true of almost any dollar we take out of any kind of registered plan, that the dollar is going to generate some tax consequences. Here it's 100% taxable as ordinary income. So let's say that we have somebody who makes a $30,000 withdrawal from their RRSP, and this person is at a 35% marginal tax rate. Well, we'll just apply that 35% to that RRSP withdrawal. So $30,000 less 35% brings me down to $19,500. That will be my net amount after tax. However, you're not going to pay that tax until tax time. Now, the government recognizes a problem with this, and we see this all the time. If you ever earned a paycheck, you know this, that you don't get to keep your full amount of paycheck. Instead, it's very common in Canada to apply a system called a withholding tax. We apply this withholding tax against taxable income. So your paycheck has this applied. You know this. You earn your paycheck. You don't get the whole amount. And then come tax time, we would look at your withholding tax paid off your paychecks throughout the year against your actual tax bill. If your withholding tax is more than your actual tax bill, you get a tax refund. If your withholding tax is less than your actual tax bill, you end up with tax payable. There's a special rate of withholding tax on RRSP withdrawals. And that rate is, if you take income between $0 to $5,000, you will have a 10% withholding tax, and that's cumulative on all your RRSP withdrawals throughout the year. So we calculate that based on all RRSP withdrawals, not on each individual RRSP withdrawal. If you take out between $5,001 to $15,000, you'll have a 20% withholding tax. And if you take out over $15,000, you will have a 30% withholding tax. Those rates are different in Quebec, but in every other province they are the same. So this taxpayer in particular has made a $30,000 withdrawal, and they will have a 30% withholding tax applied to that. That is a $9,000 withholding tax. Now we can see up here that they had a $10,500 tax burden. So the result here for this taxpayer would be they would have an extra $1,500 of tax to deal with at tax time. Fairly straightforward. Okay. They would deal with that in April-ish of the year following the year of the withdrawal. Now, there are a couple of ways that we can grab funds out of our RRSP without having to deal with these tax consequences. We'll deal with the full consequences of death in a separate video. One thing that can happen, it's not the happiest scenario, but on a transfer of assets at divorce, if you have somebody who has to transfer RRSP assets as a result of divorce or separation to an ex-spouse or a soon-to-be ex-spouse, however you want to word that, there's also no tax on that. Like I said, not really the happiest scenario. Those assets would still be registered. They would just now be registered in the hands of the person who receives them. So there's no immediate tax, but we don't get away from that eventual tax liability. Okay, like I said, probably not the happiest scenario, but that's reality. Okay, so then we can look at another scenario here, another set of scenarios, and this is around the RRSP homebuyers plan. The RRSP homebuyers plan allows me to take up to $25,000 per spouse from the RRSP without any tax to pay immediately. Okay, you have to have the funds in your RRSP, and you cannot have owned a home in Canada in the previous 4 full taxation years. So you may have not owned a home previously at all. You may have been renting for the last 5 years. You may have been a non-resident of Canada for the last 5 years. And you also can use this to purchase a home for a disabled person under certain circumstances. Okay, so basically you take this $25,000, possibly $25,000 per spouse, and you use this to buy a qualifying home The funds have to have been in there for at least 90 days prior to the withdrawal being made, and the purchase of the home has to be made in the year the RRSP withdrawal is made, or by October of the next year. And there are some fine rules around that. We don't want to go into the full level of detail here. But basically, this is it. So then what happens is you do have to repay this amount. Now, there are no repayments required in the year of purchase or in the first year after. So you don't have any repayments required right away here, but then you do have 15 years after that to repay. So after that, it's 1/15 per year that has to be repaid. If you don't make your required repayment in those 15 following years, then you're going to have taxes in that year as if you had made a withdrawal from your RRSP in that amount, which might not be so bad if you have a year with low income, for example. That might be something that's desirable. Now, a closely related concept here is around the lifelong learning plan. The lifelong learning plan is very similar to the homebuyer's plan. Under the lifelong learning plan, you can take up to $20,000 per spouse. This is to pay for yours or your spouse's education, not for the kids, okay? You take it out a maximum of $10,000 per year. And then we have to make repayments at a rate of 1/10 per year. And those repayments are going to start in either the 5th year after the first withdrawal or in the first year when you're not in school. So the lifelong learning plan, homebuyer's plan, very similar plans which allow me to withdraw funds from my RRSP without having to deal with the tax consequences, potentially ever, or at least until we fail to make repayments on the proper schedule. It is worth considering when you use either of these plans, the homebuyer's plan or the lifelong learning plan, that you are giving up on the growth that those investment dollars would otherwise have generated within your registered plan, but that may be necessary in order to actually help fund the purchase of a first home or in order to fund this return to school. I hope that's been useful. We've discussed the basics of RRSP withdrawals here and withholding tax, and the fact that it's all taxable income unless we use one of the two qualifying plans, the homebuyer's plan or lifelong learning plan. If you have any questions, please let me know. Thank you very much. Hi, and welcome back to the Business Career College video series. In this video, we're going to be talking about what happens to an RRSP on death. That is, we're going to look at the death of the annuitant, the RRSP annuitant, which we would typically in sort of casual conversation call the owner of the RRSP. This is going to be the same treatment or very nearly the same, so close to it as to make it the same for testing purposes as with the death of a RRIF owner or also with a LIF or LIRA. We're all going to have roughly the same treatment here. So the first and most important thing probably with the RRSP is that we can name a beneficiary. And if we name a beneficiary, it's very similar treatment to what we have when we name a beneficiary on an insurance contract, for example. That is, this gives us bypass of the claims of any creditors. Although you can't bypass the tax man by doing this, your taxes can't go unpaid on your RRSP. It also lets us bypass will and probate processes. So we're also going to bypass probate and the will and create a direct flow of funds to that beneficiary. Now, this is still going to be taxable. It's going to be fully taxable, the whole amount coming out. So it's going to be disposed and added. The total amount in the RRSP is added to income for the deceased on their terminal tax return. We often say it comes out of the estate. Technically speaking, that's not 100% true, but it is going to reduce the net amount of the estate. So it's going to add to the income of the deceased. That is, it'll show up on their terminal tax return in the year of death. Now, there are some possible exceptions to that. We have some potential exceptions here. And this would happen unless, that is, this taxation is going to happen unless we've named one of three possible sets of beneficiaries. The most common, of course, would be the spouse. And if you do name your spouse as beneficiary, then you just have a full rollover. And that can include also not just the spouse, but the common law partner as well. So here you get a full rollover. Nobody needs any kind of RRSP contribution. There's no RRSP room required at all here. So if you died with a $200,000 RRSP and your spouse has $300,000 in that RRSP at your death, just take the 200, add it to the 300. That person now has a $500,000 RRSP. It's very simple. Another provision here is, and this is probably the most complicated of the three, is if you have a minor child, and that can include, for example, a grandchild, adopted kids, stepkids, the whole range of possible relationships from the perspective of the Income Tax Act. It's a pretty broad range. And this person must be financially dependent, and they have to be under the age of 19. Once they're 19, they're no longer a minor child. Now, why would you want to do this? Well, there's a tax advantage here. Of course, from a parenting or estate planning perspective, this might not be ideal. But let's say we have $200,000 sitting in the RRSP at death and we have no spouse, but you do have a minor child. Well, what you might do here is, let's say this child is age 14. So we have a 14-year-old child. Now this child is going to be subject to an annuitization requirement. That is, they can't just sit on this $200,000 forever. In fact, what's going to happen here is we're going to end up spreading this $200,000 as income to this 14-year-old child over this next 5 years. So we take $200,000 divided by 5, we'd have $40,000 plus a little bit of interest. $40,000 plus a little interest every year here. And that would be added to that child's income. And if you understand how the progressive tax brackets work, you'll know that this is going to result in substantially less tax payable than if you have $200,000 of income all at one time. So this is going to spread that tax out. Now the child pays tax just like any other taxpayer, but we've spread this out now over 5 years. And probably we've kept all of this income in the lowest tax bracket instead of adding it into the highest tax bracket of our taxpayer, as we saw up here, by adding it to the income of the deceased and putting it on their terminal return. So there's a third potential recipient of this amount. The third potential recipient is an infirm child, and again, this can include a grandchild. Infirm is roughly equivalent to disabled. Once again, we're going to look for somebody who is financially dependent. So once again, we need that financial dependency. And we also don't care here about the age. This can happen at any age. And with this child, there is no annuitization requirement. So we don't have to take the money out in equal installments over a period of time like we did with the minor child. And another benefit here is we can roll up to $200,000 of that into this child's registered disability savings plan. If this child qualifies to have a registered disability savings plan, which most likely they do if they meet the criteria of infirm and disabled. There's even a fairly recent provision here that allows on death you to name your spouse as beneficiary, and then within a year afterwards your spouse can actually bounce those funds up to $200,000, the same amount here, into that disabled child's RRSP. Of course, there's always a $200,000 cap on contributions into the RRSP. I hope that helps. It is an important topic to understand what happens to the RRSP and RIF and LIF and LIRA at death. The provisions here fairly straightforward, but you certainly have to understand what happens in the case of minor child, infirm child, and spouse, and then also what happens when there is no rollover recipient available. I hope that helps, and I hope you enjoy your studies. Thank you very much.